Hello again, students. I'm back, and this is the second video for Chapter 3. We're going to continue to talk about adjusting entries, and now we're going to talk about accrued expenses and accrued revenues. If you remember from the first video, we said that in accrued expenses, the expense comes first and the cash is paid later. And in accrued revenue, the revenue is earned before the cash is received. So let's look at some T accounts. We're going to use T accounts again. Let's talk about some salary. And we're going to talk about salary expense. That'll be the expense side. And since we're going to charge the amounts to expense before we actually pay the expense, we're going to have salaries payable. You will usually always have a payable account when you have accrued expenses. I can't think of a time when you wouldn't have, actually. Alright, so let's look at salary expense. Let's say that we're at the end of an accounting period on Wednesday, but yet we pay our salaries on Friday. And let's say for the entire week, weekly salaries equal $25,000. That's for everybody. Okay? Now, we're going to pay on Friday. We pay our salaries on a weekly basis, so we'll pay on Friday, but yet the end of the accounting period comes on Wednesday, which means we need to accrue how many days of salaries? That would be Monday, Tuesday, and Wednesday, or 3 days. So we're going to take the $25,000 and divide it by 5 and multiply it times 3. So 5 into 25 will go 5,000 per day. So 3 times that would be 15,000. So we need to accrue expense of 15,000 for those 3 days so that we can wrap up the end of the accounting period and prepare our financial statements. So we're going to have a debit, because this is an expense, of 15,000, and a credit to salaries payable, because we have a liability to pay our workers. When Friday comes, we'll actually make that payment. So we're going to have a debit to salaries expense and a credit to salaries payable. Again, I'll erase this real quick so I can put up the journal entry. In journal form, that would be a debit to salary expense and a credit to salaries payable. Remember, the debit comes first, credit second. Of 15,000, debit first, credit second. Debit to the left, credit to the right. Told you you would continue to use those theories. All right. So this is the entry in T account form and in journal form to accrue salaries for 3 days when we know we're going to pay them sometime in the future. Notice something here too. For every adjusting journal entry you will have one side of the entry goes to an income statement account. The income statement accounts are revenue or expense. The other side of the adjusting entry goes to a balance sheet account, which would be an asset or a liability. In this case, here's your income statement account. Here is your balance sheet account. Okay? All right. Let's move on to accrued revenue. Now notice here again, the expense comes before the cash is actually paid. Later on, when we pay the cash, we'll debit salaries payable and credit cash. Okay? All right. Let's go on to accrued revenue. What you have to do throughout the rest of the semester is think about what's actually happening. A lot of accounting is analytical. It's not just putting things down in debit and credit format. You have to think about what's happening and what's going on, and then you can determine what your entry will be. Okay? So just keep that in mind as you go forward. Accrued revenues. This is when we earn revenue before we actually receive the cash. And so this entry is really one you've already had. And it's really the same as the transaction entry, but we do make it at the end of the period. And that would be to debit some type of receivable In this case, we'll call it accounts receivable. It could be interest receivable or some other receivable. But let's just say we've earned some revenue that has not yet been recorded in the normal course of business, so we're going to debit accounts receivable and credit fees earned. That could be interest earned or interest revenue. Okay? And let's say by determining what has been done, we have actually earned, let's say $10,000 in revenue that we have not recorded. So our entry would be a debit to accounts receivable. We haven't received it yet either. We haven't recorded it. We're recording it now, but we still haven't received it. We will receive it sometime in the future. So there's your entry for accrued revenue, a debit to accounts receivable, or as I said, it could be another type of receivable, such as interest receivable, depending on the situation, and a credit to fees earned. And if this were interest, of course, it would be interest revenue. And that was for $10,000. So there's your entry in T account form and in journal form. Okay. I think that I will go ahead and do another short video, because I'm trying to keep these videos short, to talk about depreciation, because it might take a little bit longer than I want to for this video to run. So let's make a third video. So we're going to stop for now. Okay?